Hey guys, welcome to another video of investment banking questions. So this is for the job intro questions of investment banking. So this is based on the different scenarios and how the concepts will be going forward in the IB domain. And this is the enterprise value or equity value question answer for the advanced person. So when we use the enterprise formula, so is there a problem to the enterprise formula? You just have to address like what are the items, additional item we can add in the enterprise value formula. So this is the incomplete formula right now. So it is based on the lot of other things you need to add into the formula for the real companies. Let's say the net operating loss, like that should be value or argue add in with the similar to cash. Long term investment, so this could be counted as similar to cash. Equity investment, so any investment in the other companies such should also be added similar to cash. Capital lease, like the debt we have the interest payments as well, so that should be added into the debt. Then we have the operating lease, so sometimes you need to convert the operating lease to the capital lease and edit them as well. So unfunded pencil obligations, so sometimes these are counted as a debt as well. So this is kind of the things we generally use. Then you have to use the book value or the market value while calculating the enterprise value. So technically you should use a market value for the everything, because in the practice, like how you use these market valuation data or only for the equity valuation purpose only. So but it's almost impossible to establish the market value for the rest of the items in the formula. So you just take the numbers for the company's balance sheet. Then we have the worst percentage of dilutions in the equity valuation is too high. So there's a no strict rule for that. Like the most of the bankers would say that anything above the 10% is owned. But if your basic equity value is 100 million and the diluted equity value is 105 million, you want to check your calculation. It's not necessarily wrong like everything, but over the 10% dilution is unusual for the most of the companies. So that's another scenario for them. Now we have the another question for the valuation of the questions, like we can say that the what are the three major valuation methodologies are there. So first we comparable company analysis, then the precedent transaction analysis, then we have the DCF valuation. So that's another thing. So we can rank the valuation methodology like from the highest to lowest. Is this expected value or something like that? So that's depend on the number of situations as well. Like as said, there's a no ranking that always hold that, like the precedent transactions will be higher than the comparable companies due to the control premium built in the acquisitions. Like DCF could go either way. It is the best way to say that, like it is a more variable than the other methodology and often it produce the highest value, but it can also produce the lowest value. It will depend on the assumptions for them as well. So when would you use, like not use a DCF in valuation? So you do not use the DCF if the company has the unstable and the unpredictable cash flow. So this is one. And when a debt and the working capital serve as a fundamental different role, so this is one. And the banks and financial institutions do not reinvest the debt and working capital. That's another thing, and that's a huge part of balance sheet as well. So you won't use like DCF for the such companies. So that is the one scenario. So what other methodologies are there? So first one is a liquidation valuation, like valuing a company's assets. Assume that they are sold off, or then subtracting the liabilities to determine like how much capital is there. And if the investor is received that, so that will be liquidation for them as well. Then we have the replacement value, like something like that, like valuing a company based on the cost of replacing its assets. So this is one thing. And the LBO analysis determine how much a PE firm could pay for a company to hit the target IRR. So that is the one thing, like that's valuation range for any of the them. You have to fix the, it's a LBO. For LBO you have to fix the leverage buyout. So leverage it's around 10 to 25%, and the most of them will be cash expense, so that will be there. Then the sum of parts valuation method is like valuing the each division of company separately and adding them together at the end. Let's say if you are going to sell the Reliance Group, so you have to value the Geo business separately and the another different businesses separately. Then we have the M&A premium analysis, like you analyze the M&A deals and figuring out the premium that each buyer paid. So that's using to establish like what company's worth is and how to identify that company's worth. Then we have the future share price analysis. So it's a projected a company share price based on the P multiples of the public company comparables. So then discounted it back to the present value. So that is the one thing. And apart from that, that's a future price depend on number of factors that will be defined for the different parameters of the market. So this will be another scene for the future price share analysis of the company. So this is all for the today's video. Let's meet in the next video for the better content. Please like and subscribe the channel for the more content.